All right. Good evening, everyone. Looks like it's right around 6 o'clock. So let's go ahead and get this webinar started. First, I just want to thank everyone for showing up and showing up on time. I know that time is the most valuable non-renewable resource you have, and I do want to make sure we respect that. I do expect this webinar to take anywhere from 30 to 35 minutes for the main presentation, plus however long the Q&A portion lasts. And speaking of questions, if you do have any questions, please feel free to just click on the little Q&A button at the bottom of your screen and type them in at any point in time. If there's one that's particularly applicable to what we're going on, we'll go ahead and cover it during the presentation. Otherwise, we'll make sure we cover all the questions at the end of the session. And I realize some questions might be either too complicated or just too personal to answer in a public webinar setting like this. So if you have a more complicated or more personal question, let us know. We can schedule a time for a one-on-one conversation to get that figured out for you. You can either click on the chat and let us know, or give us a call or shoot us an email and we'll get it figured out. So with that out of the way, let me go ahead and introduce to you David Sullivan. David is the Regional Director and Vice President at Dimensional's Global Client Group. David is responsible for providing education like this on Dimensional's investment philosophy and maintaining relationships with financial advisors like us. He's earned his MBA in finance and entrepreneurship at the University of Chicago, their School of Business, and he's got over 20 years of experience in the financial industry. So with that out of the way, I'll go ahead and pass it over to David and let him take it from here.
Great. Thank you so much, Logan and Linus. And thank you to everyone who's on the call and interested in hearing a little bit more about what we do, how we do it, and maybe more importantly, why we do what we do overall. As mentioned, I am David Sullivan with Dimensional Fund Advisors, also known as DFA. We may not be a household name, but you certainly will see us on statements, and you'll certainly see us in the financial publications and premier financial journals overall. But with that, what I would love to do is just really give you the purpose of why we're here tonight, and to go through a number of things like that, and then go through these slides that I've prepared for all of you tonight. And as Logan mentioned, we'll cover it in about 30 minutes, 35 minutes, and then answer any and all questions that you have as appropriate here for this session. So thinking about the purpose and why are we here, and what is this investment presentation relative to many other investment presentations you may have seen or may be familiar with. And really it's a few things. First, it's to showcase what we do as Dimensional Fund Advisors, as a premier investment manager, and our unique and differentiated approach to investing. What do I mean by that? Academic research is what drives us rather than Wall Street research. We'll talk about what that really means overall, but think about that and our commitment to building a portfolio based on academic research rather than traditional Wall Street research. Secondly, is to talk about a relationship with financial advisors. We have two channels that we serve: financial advisors as well as premier financial institutions. And we feel that is the way that you're going to have the best experience in your financial journey overall. And one of the reasons is to have a guide, to have an advisor that will help you through all steps of your life and financial journey to allow you to achieve the goals that you truly set out to achieve. Sending children to college, preparing for a vacation home, retiring, leaving a legacy, all of that is essential. And the way we love to work to accomplish those goals is to work with financial advisors. And then lastly, thinking about us overall, we truly believe in lower cost and having reasonable costs in our portfolio to make sure that we're delivering great value for these overall portfolios while keeping it at a very reasonable cost. So you'll see those three themes represented throughout all of it. So the purpose will be to go through that. What will be the benefit to all of you is to really see what we're doing as an investment manager and really ask any and all questions that you have to help address our unique and differentiated approach that I talked about before, and what it really means about academic research rather than Wall Street sell-side research. So with that, I hope that sounds great to everybody, and I will jump right into these slides. This is a slide deck called the Foundational Principles. And so we're going to cover all these slides here as we go through this presentation. So with that, let's talk about what the foundational principles are. And, if we think of investing just as a whole and what people like to do from an investment standpoint is they want to look at prices, right? Why? Prices absolutely matter. Okay, so what do prices reflect? Aggregate information that is out there. If you think about some firm or some company launching a new product, having a new service, getting into a new market, all of the price that we see on stocks reflect that when that occurs. So we're going to talk about how that relates to our process and approach. Also think about the dimensions of returns. Are all stocks created the same? Do they all have the same identical return? Well, the answer is no, we know that. But what differentiates one stock from another, and how do we weight, or how do we overall emphasize the stocks that have characteristics that should outperform? And then lastly, how do we implement? If we think about the ways that we look at the stock market, we look at investing, can anyone do this? Or do we need that expertise and years and decades worth of experience working in financial markets? We would say that the decades of experience working in financial markets gives us an advantage. It allows us to truly implement in a way that captures higher returns going forward. So these are the foundation principles: prices, premiums, and implementation overall. So what I like to do is use more alliteration, and the way to do that is prices, premiums, and process. So we're going to go through each of these three areas here in kind of a fun way overall to have you understand how we look at those three specific areas. I built out a grid so we can go through each of these areas as it relates to different disciplines of investing. What you'll see here, the different disciplines of investing: stock picking. What is that? That's just picking individual companies from the entire universe of stocks that you can invest in and saying, I believe these 5, these 10, maybe these 15 or 20 companies will outperform based on my thoughts, right? So that's one discipline. That's one way to approach investing. A team, a couple people, choose 1, 2, 3, 5, 10, 20 stocks overall that they think that's going to outperform. How is that going to relate to prices, premiums, and process? Another discipline, rather than stock picking, is index management. And what is index management? Well, picture, instead of picking 5, 10, 15, 20 stocks, you're going to pick all 3,000 stocks. Or if you're familiar with the S&P 500, I'm just going to pick 500 stocks. And I don't care if one company comes in, I'll pick that one, and then one company leaves, I'll get rid of that one. That's index management. How do they look at prices, premiums, and process? And then lastly, the discipline that we employ at Dimensional is really the dimensional way of investing. And how is that different from a traditional stock picking approach, an index approach, and how does it relate to the 3 Ps: prices, premiums, and process? So we're going to fill out this grid together. We're going to go through this, but the way that we're going to start is looking at stock picking and their approach on prices. So many times you'll hear on CNBC, or maybe you watch Mad Money. We always feel like that entertainment television can sometimes lead to very poor results. So use it for entertainment rather than for financial advice. But regardless, what are they doing and what are they trying to talk about there overall? Well, they're talking about prices, and they a lot of times look at prices of whether it be different commodities, different goods, different things that we see overall. And typically they say, well, given where prices are, and we'll use a stock as an example, given where the price of Apple Corporation is, right? We know Apple, Apple Computer, the watch, iPad, iPod, all of those great things. Many times they'll say, well, Apple is incorrectly priced. Okay, so what do they mean? Well, they mean where it's currently trading, around $200 a share, is wrong. If they think it's wrong, they might think, okay, it should be $220 or $250 or maybe $500, but they believe the price is incorrect. On the other side, they could say, well, I believe Apple should only be worth $150. It shouldn't be worth $200. So they're constantly arguing with the price that's out in the market today. We like to say that's really not the best approach, given the fact that we can look at any other goods or services out there and not question whether or not that's overvalued or undervalued. Good example would be with milk. When you go to the grocery store, the local grocery store of choice, do you walk in and say, oh, this milk, nope, $3.50 a gallon, it's completely wrong. It should be 4, or it should be 2, or it should be something different. Nope, I just don't trust in this price. No, you look at it and say, okay, well, currently the grocery store has this milk for this specific price. Well, milk prices have gone up. That's why it's higher. Milk prices have gone down. That's why it's lower. Similar with gas, somewhere with toothpaste, all of that stuff, we take those prices as the market reflects them, supply and demand. We don't go into any grocery store and just say, I'm not buying any milk because it's absolutely incorrectly priced. No, we buy it because that's the information that's out there. Does it change? Absolutely. But we trust in prices. So I give you that analogy and that reason is because if you think about it, it's very similar to the way that stocks are priced. Stocks work in a very well-functioning market. In other words, there are many participants buying and selling on a regular basis, and information gets incorporated very quickly into that price. Let me give you one example of a stock here. We were just talking about grocery store goods and items like that, but if we think about a stock overall that many of you are familiar with, it's Heinz Corporation. And Heinz Corporation was trading around $60 a share back in 2013. So January is going on, goes up a little bit in February, supply and demand, people are deciding whether or not to buy. Well, what happens to Heinz on Valentine's Day? Well, Heinz agrees to a buyout by Berkshire Hathaway. If you're familiar with Warren Buffett and Charlie Munger, rest in peace, recently passed away. But they both at Berkshire Hathaway thought this was a great stock to buy. Well, when they announced this on February 14th, Valentine's Day, what happens to the price? Well, they delivered a buyout price of around $70. The stock immediately went up to $70. Okay, so that makes sense, right? If somebody's going to buy it for $70, why would it trade lower than that? But my point on this is if you see that straight line, it goes up almost immediately. And if you look at the volume that happened on that day, it went up because people were trying to capture that price prior to it hitting that overall price of $70. They wanted to get in before it went up to 70, but it's next to impossible to do, as you can see, because there's so many shares being traded. So on this, you can see stock prices adjust very quickly given the new news that's out there. Now, at the time that it was announced, what happens to the overall price? Well, actually trades pretty flat overall. As you can see, once it gets to around $70 a share, it goes up a little bit because people think, well, maybe somebody else is coming in to buy this at a higher price. And they realize, well, that's really not going to happen. And then it goes down here, maybe because they think that the deal won't go through, but ultimately it trades around the same. So stock prices will trade based on that information that's out there in the overall market. So it's very difficult to capture this in any meaningful way, especially given the fact they change so quickly. So what happens there? Well, we know they react in a very fast manner overall. And also prices are forward-looking. What do I mean by that? It's looking at how will this stock do in the future, not just what's it doing right now. Good example is we looked a few weeks ago and said, wow, the economy is somewhat shaky. We don't know if they're going to increase interest rates, decrease interest rates, inflation's going to creep up. We see the stock market going up. Why is that? Well, it's because they're forward looking. They're looking at the future, not just what's happening today, but rather looking at what's going to happen 9, 12, 18 months down the road. And then also competition makes it very hard to systematically identify and profit from any mispricing. Going back to that example of Heinz, well, I believe I can capture this $70 a share for Heinz before anybody else does. Well, it's highly unlikely because they adjust so quickly there. And also, if we look at the sheer volume of the stocks and stock market, almost $676 billion in daily stock trading. So if I feel like I want to buy 100 shares of Heinz, even 1,000 shares of Heinz, for a significant dollar amount in my eyes, it still pales in comparison with the total volume of stocks being traded overall. So I gave you the example of one individual company, but what are these other portfolio managers doing, these stock picker managers? They're buying more than just one company, of course, but what they're trying to accomplish is overall beat the market by picking stocks that they feel are not valued correctly or will outperform. So as you can see here, they're buying the ones in blue of the entire market. Now, if you think about the entire graph that I show here, that's picture that to be the stock market, all the stocks there. And what they're doing is trying to buy those blue ones and sell the white ones when they discern them to be or deemed overvalued. But what does that lead to? Does it really lead to a lot of success overall? Well, let's take a look at the results. So we've run the results here of how these stock pickers, these folks that are trying to identify mispricings and capitalize on those, how they've done over a 10, 15, and 20-year period. So if we think about 10 years, 68% of the managers who take this approach have survived. In other words, they didn't close the fund, shutter the fund went out of business. 68% survived. Okay, so of those 68% that survived, actually are still around, only 27% of them are winners. In other words, beating the overall stock market as a whole. Not that great of odds. Well, what happens in 15 years? Well, you can see very similar story. Actually, worse returns, though, over that 15-year period. And then 20 years, even worse returns. So in this case, it's saying that no matter if I'm holding on to these ideas that are trying to beat the market through stock picking and not choosing the whole overall market, but just the ones that I feel as a manager overvalued or undervalued, the results haven't proven to be very fruitful. Less than half of those companies that have invested in taking that investing approach are around, and then only 17% have actually beat their respective benchmark. The results really haven't shown that this approach works overall. So that discipline of stock picking, choosing a few companies amongst the market based on prices and trying to outguess, this hasn't worked out. So let's think about the indexing approach. What is the indexing approach? Once again, covering the entire market and not just picking a few, but picking every single stock that's out there. So if we look at this as the market portfolio, it's owning every single stock, perhaps we're going to just choose a small subset of that and just choose an index that represents the smallest stocks. Okay, sounds good. Well, we're going to buy that. If we're an index manager, we're going to buy all those stocks on day one. And what do? Well, we hold on to those, and it represents the index that we're investing in. And then what happens? Well, 6 months later, some stocks that were small now have gone up in value, no longer considered small. Some companies that were large have dropped in value, and now they're in the small cap range or in the small company range. But this is looking at just an index based on one specific period of time. So what does that lead to? Well, it leads to utilizing stale information. If we're only looking at this once a year, we're going to have stale information because prices change every single day and intraday, of course. I was using an example earlier to think about how do you like to approach your overall haircuts? Do you like to get a haircut regularly, perhaps monthly, or do you want to get it once a year? I mean, if I got a haircut once a year, you probably would say, wow, this guy is very sloppy and does not look like somebody who would be in the investment industry because my hair would cover my entire face. Rather, I want to get my hair cut much more regularly. So I want to have that approach over and over, whereas index managers only do that once a year, maybe 4 times a year if you're lucky. But they're utilizing stale information, and we don't feel that's the best approach to have outperformance. So what do we do at Dimensional? So looking at both those disciplines, we want to take the best of both disciplines and make our strategy adhere to that to beat the market. So we're going to still look at a specific area of the market. We're going to own most of the stocks that are in there, but we take a dynamic approach where every single day we're looking at the prices of these stocks and we can buy and sell depending on whether or not they go into or out of the respective area of investment in a small cap space overall. This chart here hopefully highlights that as well for you. So if we think about a stock price and the price is changing, say for instance, the price goes down. A good example would be Apple, right? I use Apple because I own an iPhone, iPad, iPod, you name it. I own that. And so because of that, I think about Apple as a stock and a company I'm familiar with. If the stock price goes down over time, its expected return goes up. And why is that? Well, because there are characteristics in stocks where you see that the stock price has gone down relative to what it's worth. It becomes more attractive, similar to a house, right? You look at a house here in the neighborhood and think, wow, that house that was $1 million is now selling for $950,000. I think it's going to go back up to $1 million. It just so happens interest rates are pretty high. I want to buy it now. It seems like it's a good deal. As the prices go down, the expected return changes and goes up. That's what we're doing overall at Dimensional in the portfolio. We're looking at changes daily and incorporating those into the portfolio. So those are the prices. Thinking about prices, we believe that prices are the great representation of all information that's out there, and we want to utilize these to capture better returns. Now, if we think about premiums, right? So we talk about prices, premiums. What is the premium? Premiums are just differences between certain areas or categories of stocks. That's all premium means. This is not insurance premiums or it's a payment, et cetera, but rather it's just a difference between two sets of stocks. Now, the question comes up then, thinking about that, do all stocks have the same expected return? Okay, well, we know the answer to that is no. And why is that? Well, does Walmart, we're all familiar with Walmart as a company, does that have the same expected return as Apple? No, it's a completely different company, completely different business model overall. So why would we invest in those the same exact way? Well, we would say that we would not. And I like to use this as an example as well. We can wind the clock back, to maybe early part of the 20th century and say, at the time, if you had an issue, any medical issue, perhaps going to the doctor and say, well, doc, I've been having these headaches for a while. I don't know what the cause is. What do you think I should do? What is the doctor going to do? Well, at the time, best technology they had was do an x-ray. Check the x-ray. Okay. Looks like everything's fine. Wind the clock forward to today, you can say, well, rather than just taking an x-ray, perhaps we do an MRI and a scan to really see what's going on inside the head, utilizing information that actually can think about where the issue may be. So utilizing technology, we call this an evidence-based approach overall. We take that at Dimensional into how we manage portfolios. Evidence-based, the evidence, looking back at years of academic research, even decades, about 100 years worth of research, we've identified areas of the market and the stock market that have actually gone up over time to drive that higher value. So we are utilizing the most up-to-date research and information to incorporate that into overall portfolios. Another way to look at that is to go back to that stock pickers example, that one discipline. Many times what they do is they'll say, well, I think there's another way to do it. I believe, after thinking today in the shower about how I can analyze this, I believe there's a new way and I want to try this out. We feel that's really not the best approach because no one that I know would go to a doctor and say, okay, doctor, I have this issue, this ailment. How have you treated in the past? Well, I've treated 1,000 patients all this way, and the likelihood of success has been over 90%. Okay, great, I want to do that. Versus, hey, you know what, I have a new idea. I know I've treated this many ways in the past or the same way in the past, but now I'm thinking about a different way. How about I try that on you? You're not going to like that. Nobody would like that. And that's not taking academic research. That's not using a systematic approach or an evidence-based approach. It's rather using just some person's idea that they've come up with. So we don't rely on that, but rather we look at decades and even a century worth of data coming from leaders in asset pricing research. Who are those leaders? Well, Nobel Prize winners. Most of these people have been involved with us since day one. We as a firm started in 1981. So we're thinking about 42 years ago, and we've incorporated the best minds in academic science to help us understand where returns come from and how to build portfolios that drive higher returns. Now, I mentioned premiums, and we think about the differences in overall returns. If we think about this as a series of stocks overall in a market, there are different companies. Large companies are represented by the larger circles, smaller companies by the smaller ones. We can actually group these into categories. We can say these larger companies are considered large cap or large capitalization. These are the big companies, the General Electrics of the world, the Boeings, the Johnson & Johnson, Coca-Cola, right? Let's group those together. We also have small companies, right? What would we consider that? Well, as an example, Under Armour would be one that we're familiar with, smaller company, but still fairly well known overall. We look at and group all those companies that are smaller into one area and larger companies in another area. They have different returns, right? They act differently. Now, not only do we do that, then we also switch between, lower prices relative to book value is considered value. So if you have a lower price and you're a large company, you fit in that box. If you are lower price and a smaller company, you fit in that small box in the lower left. And then growth as well. So we do this to categorize these stocks. Is one thing, they have different return elements and characteristics. Now, what does a stock picker do in that case? Well, looking at the overall portfolio, what they're trying to accomplish is to sell securities when, once again, they're deemed overvalued, and buy securities or stocks when they think they're undervalued and will outperform. Overall, but what does that lead to? High turnover, trading the portfolio a lot, and typically higher costs. So we look at stock pickers to say they're delivering incomplete exposure to premiums. They're not capturing those differences in returns, rather just picking a couple individual stocks to try to outperform. Now, transitioning over to an index approach. Once again, an index approach covering the entire stock market. What do? Well, they look at the entire stock market and say, okay, given the market, we want to choose a certain area. Once again, they want to choose small cap. They deem this to be the appropriate basket to buy. And once they do this, they'll say, well, once again, we're holding all of those stocks overall. But once again, stocks that were once considered small have gone up in price and now are not considered small any longer, or about companies that are larger, maybe dropped in price and considered smaller. So they're getting this similar approach that you saw with using stale information, but also delivering incomplete exposure. They're not capturing that day in and day out because of that stale information. Now, what are we doing, and how is that different? Well, we think about this overall in a very similar manner that we thought about with prices. We decided we want to choose this area to invest in overall, but every single day we're buying and selling stocks as it relates to the expected returns. And that's how we're focused in on the premiums. So we're providing continuous focus overall when we think about the premiums. Now, before we get to process, look at there was a question I saw in the Q&A box. Is that something we'd like to address now, Logan, or is that something that we can address later?
Yeah, that's a question that I've already addressed. So if there are
follow-up thank you.
questions, we can get into those.
Okay, great. Well, thank you for mentioning that and addressing that. And any others that come up, just let me know. I saw that a little bit later, but thank you for addressing that. We'll now get into process. And what do I mean by process? It's really our overall approach that we take as an investment firm. And really, this is the why we do what we do in the way that we do it. So I mentioned earlier that we believe in lower costs, really reasonable costs. You'll always see us in the lowest decile, so it's 10% of costs from an investment management standpoint. We're committed to that, focused our resources on working with advisors and premier institutions, and allows us to do that. Now, if you think of many other fund companies and complexes, a lot of times they have pretty expensive products and pretty expensive solutions. What do I mean by that? Well, over a 20-year period, median expense ratio, the cost of ownership of a fund that's considered high is 1.72%. In the financial industry, that is pretty expensive for an investment manager to take before you get the overall returns. If you look at the low side, 0.83, that's the lowest based on the median in that category, and it's taking less. Still, it's still a decent amount that's coming out of the portfolio before you get your return, but it's in the low category. Now, if we think of all of these areas and how it relates to winners, in other words, firms have beat their overall respective index or benchmark, on the low side, right, the low cost or low fee, 29% have won. So even with those lower fees, still doesn't lead to great results. But what does it lead to from a loser standpoint? You can see a lot more losers that are there that have not beat the market. It'd be better to own a passive or index approach than do this. That's what this data is saying over there. And if you go to a high fee mutual fund or investment, 6% have won. Not good results at all. It doesn't really put the odds in your favor. We like to say at Dimensional that by having higher fees, it's like starting a 50-yard dash 10 yards before the start line. You're really not putting yourself in a good position overall to beat the overall respective benchmark. Now, what about turnover? What is turnover? Trading the portfolio rapidly and getting a lot of stocks in the portfolio, out of the portfolio, trying to time things overall. We like to buy stocks when we see an appropriate time to buy, making meaningful trades, but we're not just trading the portfolio to trade it overall. Rather, we're trading the portfolio in a meaningful way to enhance value. So, excuse me. So if you have low turnover, in other words, you're not trading the portfolio all that much, 26%, what happens? Well, 30% of the time you're getting winners, right? But if you have a high turnover strategy, more than 130 or around 130%, about 10% have been winners. So we like to say, let's keep turnover reasonable, right? Not trade the portfolio and turn it over a lot, only make meaningful trades. But the firms that are doing this, it's like starting the 50-yard dash, not only 10 yards before the start line, but also with a parachute on your back. We feel like this is going to be the best approach to truly win the race or to achieve that success. We would say absolutely not. So we want to make sure that we're keeping fees and costs reasonable. Stock pickers, unfortunately, add unnecessary costs in both of those areas. Now, what do index funds do? Now, a lot of times people say, well, index funds are low cost and they're not really charging all that much overall. Okay, so what is an index fund? Well, an index fund looks at an index, right? That's the entire US stock market, for example. And then it just represents all of the replications of the index in different fashions and different manners. And many times companies are trying to replicate the overall index by having a fund. But what happens? All these index funds that are created based on a similar index have to trade stocks at the exact same time. Now, why do they do that? Well, because the index reconstitutes or changes once a year, perhaps 4 times a year. But when it does that, what occurs? Well, all these index managers have to trade at the same time, and they're buying the companies that are going into the index and selling the companies that go out of the index. Well, every index company is doing that. Very efficient, and it leads to immediacy-driven results. And not only are they trading on the same day, they're typically trading right at the same hour, right before the stock market closes. So they're not getting the most efficient price, and it really leads to a rigidity or a very rigid approach and lacks flexibility. We don't like that. We feel like an approach in that sense, driving that immediacy, doesn't deliver a great investor experience. So what do we do at Dimensional? We instead look at the entire stock market and say, let's make changes as academic research guides us, as expected returns and characteristics change to be favorable, because our goal is to utilize this research, this academic research, to deliver an exceptional experience day in and day out. And how do we do that? Well, the research guides us to do that and build portfolios designed to increase expected return, to manage risk, to control costs, to really put the odds in your favor to have a better investment outcome overall. And from a portfolio management standpoint, we're not using stale information. We're looking at the market every single day, trusting in the prices and building a portfolio around the prices that we see out there, really harnessing the power of the stock market rather than fighting it and saying all the prices that we see out there today or tomorrow are wrong. Rather, we embrace market pricing to drive an overall exceptional experience and return. And we do trading in a way that's very meaningful. We're only doing trading to enhance the value of the portfolio, not to trade to try to capture what we believe would be a stock that's undervalued or overvalued, but rather trading in a meaningful way. All of this incorporates into our approach, why we do it and how we do it. But in summary, this approach and this process, we absolutely love and we employ, and it's led to great results, but we could not do all this without utilizing the expertise of financial advisors, because the financial advisor and the role that they play is to help all investors stay disciplined, on target, and understand how all these things work together to really drive that investment expertise. Not only have they chosen us, but we've chosen them as well to represent our investments, because overall as a firm, we believe that working with professionals, financial professionals who understand what we do and why we do it leads to that exceptional result. So with that, I am at the end of my slides here. So anything that I can answer or address for you now, I'd be happy to do that.
Yeah, thank you, David. That was really nice. I appreciate it. And just while we're waiting on people to put in the questions into the Q&A session, our relationship with Dimensional. So as independent financial advisors, we're able to use a whole wide variety of different investments and providers and mutual fund companies. And Dimensional is one that we find ourselves coming back to again and again. The Nobel Prize winning research, and the consistency with which they've used that research over a long period of time has really led us to use Dimensional, not just for our clients, but also in my personal account. I use the Dimensional funds. It's something that I use myself. On a separate note, while today's webinar has largely been focused on investing in the foundational principles therein, and investing is an important part of what we do, it's just one piece. We're a holistic financial planning firm. We have 2 certified financial planners with decades of financial planning experience, and we help clients with their retirement, the retirement income planning, tax planning, estate planning, risk management, education, Social Security, Medicare planning, special situations. And we can really tailor that advice based on their personal or family situation. So if you think there might be some value in you asking us some one-on-one questions or just getting a second opinion, if you want, let us know. I'll put our phone number and email in the chat. So if you want to give us a call or shoot us an email, you're welcome to do so. And with that, it looks like we do have a question here for you, David. Um,
Yes.
do you are you able to discuss any of the past returns and what types of portfolio or investments do you have?
Great. Thank you for that question. So if we go back to 1981, so we were founded in 1981, and we had at the time a mutual fund, an investment strategy that went and looked at the smallest companies that were out there, essentially the smallest two deciles of the U.S. stock market. And we invested exactly in this approach that we're talking about here that I covered today. And we did that, and we said, okay, what do the results look like? Well, at the time, that was called our 9-10 fund for being the smallest two deciles of the market, but actually is now named our micro cap fund, micro being the smallest part of the market. And what that has done on average since 1981, it's beat its respective benchmark. So it's outperformed owning all of those stocks, right, in the benchmark by about 150 basis points on average every year. So that's 1.5% every year since inception has been the average outperformance. So if we look at our oldest investment approach, investment portfolio, we can use that as one of the ways to look at what our longest term performance has been overall. So that's been very positive. We've been excited about that. We have 120 different investment vehicles and portfolios, everything from international, so picture like continental Europe, to Japanese stocks, to emerging markets where we're looking at Indian stocks and South Korea and Taiwanese stocks. So we have a wide variety of portfolios. We manage these on a regular basis, and our goal is to beat its respective benchmarks. So going back to your question on performance, you can look at our public website, or Logan and Linus can show you returns on those portfolios. But really, if you think about how they build the portfolios for you and the models, the investment models that we have available, maybe relates to exactly your investment experience and your performance overall, given when you invested all the way to the present day. You can certainly look at that, or, as Logan and Linus build out additional portfolios, how those returns have been. Our goal overall is to beat the stock market, not through fancy stock picking, but through those systematic drivers of returns, keeping costs low as well. And then the financial advisor's role is to help keep you disciplined, keep the portfolio driven towards your goals, and keep you disciplined to stay in, especially in times that are challenging, like we've seen over the summer. But then when we've seen the market come roaring back most recently, to allow you to reap those rewards due to staying disciplined and staying in your seat. So in summary, look at the overall returns of your specific portfolios, or look at our public website to see how our funds have done, and also know our oldest strategy has beat its respective benchmark by 1.5% on average every year since 1981. So hopefully that gives you a good feeling for what our performance has been on our portfolios.
Okay, thank you, David. And I know one of the three main dimensions that I've heard you looking at. There's the size of the company, the value versus growth, and then the profitability of the company. Are those still the main three dimensions that you're utilizing, or are there some others that you've started to implement as well?
Yeah, great question. So if we look at the research, 95% of all returns come from those three categories that I mentioned earlier that Logan nicely summarized for everybody: the size of the company, the price we pay, and how profitable it is. Now, there's many more that are out there. You could say, well, what about the momentum of a stock? When you see a stock price going up, for some reason, it seems like it continues to go up, or if it goes down, it seems like it continues to go down. We look at all of the different factors or areas of the market that have differences in returns. There have been about 200 that are out there, but what we've identified are those three that represent approximately 95% of where all returns come from. As financial science continues and as research continues to grow, we're always looking at other ways to get higher returns. And if there is another one that comes out, a premium that comes out, or an area of the market that we just for some reason haven't noticed before, we will incorporate into our overall investment strategy. But those three that we mentioned, the size of the company, the relative price of the company, and how profitable the company is, truly represent 95% of return. So we are building that into all of our stock portfolios.
Okay. Thank you very much, David. I'm not seeing any more questions that have popped up. So maybe we give everyone an extra minute or two to get in the last minute question. And then I think I promised about 30 to 35 minutes plus a Q&A. I think we've just about hit that. And again, thank you everyone for showing up. I know your time is valuable, and I feel honored that you spent it here with us. So I'm not seeing anything else popping up just yet. So I think now's a safe time to go ahead and close this out. And again, if you do have any questions that you weren't really able to get answered here, if you want to, you can go ahead and shoot us an email or give us a call, and we'd be happy to set up a time just to talk and get you figured out. So I think with that, we'll go ahead and let everyone get on with their evening, have some dinner, and have a good day. All right.
Great. Thank you, everyone. Thank you, Logan. Thank you, Linus.
Thank you, Logan.
I appreciate it. We'll
Yep.
see everyone later. Bye.
Good to see everybody.